So class, today we'll look at Chapter 8, Stock Valuation. Remember we've said that to value any security, we look at the present value of the expected cash flows associated with that security. And remember we also said that it's always the future cash flows which are discounted. If a cash flow has already been paid, then we do not discount that cash flow. So today we look at Chapter 8, the stock valuation. What are the key concepts from this chapter? We look at how stock prices depend on future dividends and dividend growth. We also look at how we compute stock prices using the dividend growth model. This model is very important as we go on. We'll also understand how corporate directors are elected. Very briefly, we'll look at that. We'll also look at how the stock markets work, and finally, how stock prices are quoted. You should be very familiar with how stock prices are quoted. After all, you've completed assignment number 1, where you had to go in and get information about your company. So today let's look at the chapter outline just very briefly. Common stock valuation, very important. We'll also look at some features of common and preferred stock, and finally the stock market. So let's look at cash flow for stockholders. Okay, if you buy a share of stock, let's say from Facebook or Apple, you can receive cash in 2 ways. 1, the company could either pay you a dividend, or 2, you could sell your shares either to another investor in the market or back to the company. Right? As we said, with bonds, the price of the stock is the present value of these expected cash flows. So we use the same concept when we talk about value in stock. We're finding the present value of the expected cash flows associated with a stock. So let's look at an example. Suppose you're thinking of purchasing the stock of More Oil Incorporated. You expect it to pay a dividend of $2 in 1 year, and you believe that the stock can be sold for $14 at that time. You require a return of 20% on investments of this risk. What is the maximum you'd be willing to pay for this stock? In other words, what is the stock price? Well, ask yourself this: what are the future cash flows associated with this stock? It's the $2 dividend that you will get next year, plus the fact that it's valued at, or you could sell it for $14 next year. So your total cash flow in 1 year is $16. You find the present value of the $16, your discount rate or your required return is 20%. And you see that you compute that present value, you see that the price of the stock is $13.33. If we move on to a 2-period example, you decide to hold the stock for 2 years. So in addition to the dividend you receive in 1 year, if you remember that was $2, you expect a dividend of $2.10 in 2 years, and you could sell the stock at that time for $14.70. How much would you be willing to pay for the stock? Once again, you discount the expected future cash flows associated with that stock back to the present to get the stock price. So in year 1, you see $2, that's your cash flow, that's your dividend. In year 2, since you're only holding the stock for 2 years, in year 2 you receive that second dividend of $2.10 plus the price it can be sold for at that time, $14.70, and you discount these cash flows to the present, and you see once again the stock is valued at $13.33. What if you decide to hold the stock for 3 years? Well, it doesn't change. In addition to the dividends you receive in years 1 and 2, You expect to receive a dividend of 2.205 at the end of year 3, and at that time you could sell the stock for $15.435. Now, how much would you be willing to pay for this stock now? The process doesn't change, as you could see. You're discounting your future cash flows back to the present. In year 1, you get $2. In year 2, you get $2.10. And in year 3, you get 2.205 plus 15.35, which is the amount you could sell the stock for. And you see that the stock is valued at $13.33. So let's develop the model. You could continue to push back the year in which you will sell the stock. And you will find exactly what we've been saying all along, that the price of the stock is just the present value of all expected future dividends. And this becomes important. I want you to highlight this. The present value of all expected future dividends. So therefore, how can we estimate all future dividend payments? Well, we have 3 cases which you should know very well by the end of this chapter. What are the 3 cases? The first case is where you have a constant dividend, where the firm will pay a constant dividend forever. You think immediately of a perpetuity. And as we've said before, a good example of a perpetuity is preferred stock. So to find the price of preferred stock, you use the perpetuity formula, which is the present value, or the price, is equal to C over R. In this case, our C is our dividend. So you could say the price of preferred stock is equal to D, as in dividend, over R, your discount rate or your required rate of return. The second case is where we have constant dividend growth, where the firm will increase the dividend by a constant % every period. That is your G. How do we compute the price of the stock in this case? We use the growing perpetuity model, which you should be familiar with from chapter 6, where we said the price of the stock, or the present value, is equal to C over R minus G. In this case, our C will be our next dividend, or D sub 1, as you'll see a little later. Finally, we have what we call supernormal growth, which is the case that most students have a lot of trouble grasping. So we'll go through that using many examples later on. Dividend growth is not consistent initially, but then it settles down to constant growth eventually. So what we do in this case really is use a 2-stage or multi-stage model, where we first find the price of the stock at the point where you have constant dividend growth using the growing perpetuity model, and then we discount these cash flows using the dividend discount model. So I hope that you're getting everything thus far. We'll do some examples later on, and I think as we do these examples, you'll have a better grasp of what we're talking about here. So let's look at zero growth. If there's zero growth, what do we have? Essentially a perpetuity. If dividends are expected at regular intervals forever, then this is nothing but a perpetuity, and the present value of these expected future dividends can be found using the perpetuity formula, where the price of the stock, as you could see, is D over R. Let's look at an example. Suppose stock is expected to pay 50 cents dividend every quarter, and the required return is 10%, but with quarterly compounding. What is the price? You see here there's no growth. We're dealing with a perpetuity D over R, right? So your dividend, your expected dividend is 50 cents, as you see, and your required return is 10%, but with quarterly compounding, which is why you divide the 10% by 4 to get a stock price of $20. Let's move on to the dividend growth model, where dividends are expected to grow at a constant percent per period, as we heard earlier. You could ignore all of this. This is part of the derivation of the formula. This is the formula that you should be very familiar with. When we have constant growth, the price of the stock is equal to your next dividend, or D sub 1, over R minus G, where R is your discount rate or your required return and G is your growth rate. Take note that if you're given a dividend that has already been paid, that is your D sub 0. So you need to multiply by the growth rate 1 plus G in order to get your D1. Let's do an example. Take note of this formula. This formula is very, very important. It is used when we have constant growth. Suppose Big D Inc. just paid a dividend of 50 cents per share. Take note, just paid means the dividend has already been paid, so that's your D sub 0. It is expected to increase its dividend by 2% per year, so this 2% is your growth rate, your G. If the market requires a return of 15% on assets of this risk, so your required return is 15%, what is the price of the stock, or how much should the stock be selling for? You see here, first thing once again to note that 50 cents is not a future dividend. It is a dividend that has already been paid, so you need to multiply by 1.02 because 2% is your growth rate. And then you divide that by 0.15 minus 0.02, or your R minus G. And you see that the price of the stock is $3.92. Let's look at a slightly different example. In this case, suppose TB Pirates is expected to pay a $2 dividend in 1 year. Take note that this dividend has not yet been paid. It's a future dividend, so that's your D sub 1. If the dividend is expected to grow at 5% per year, which means your growth rate is 5%, and the required return is 20%, what is the price? Again, using the constant growth formula, you see that the price is $13.33. Take note once again that because you're given the expected dividend, a dividend that has not yet been paid, the $2 in the numerator is not multiplied by 1.05. So to answer the question, why isn't the $2 in the numerator multiplied by 1.05 in this example, the answer is because it is a future dividend. It has not yet been paid. It's the expected dividend. So let's look at these graphs. And these here, this graph shows your stock price sensitivity to dividend growth. And what you should notice from this is that as G, your growth rate approaches R, the stock price increases dramatically. And you see that in this graph. As G approaches R, the stock price increases dramatically. In the next graph, stock price sensitivity to the required return, you see that as R approaches G, the stock price increases dramatically, right? So what should you note from these? Well, the higher your growth rate, investors will pay a higher stock price. Because if your company is expected to grow at a high rate, then investors will be willing to pay a higher stock price. The higher the payout ratio, meaning the more dividends that are paid out, investors will pay a higher stock price, right? The less risky the stock, meaning the lower you are, investors will pay a higher stock price. Okay, so you want to take note of these. The higher the growth rate, the higher the stock price. The higher the dividend payout ratio, the higher the stock price. The less risky the stock, which means the lower you are, investors will pay a higher stock price. I hope you've understood what we've covered this far. Let's look at another example. One growth company is expected to pay a dividend of $4 next period, and dividends are expected to grow at 6% per year. The required return is 16%. What is the current price? Once again, $4 is your expected dividend. Your divided by R minus G. Your R is 16% and your G is 6%. Very important. Highlight the last point. Remember that we already have the dividend expected next year, so we don't multiply the dividend by 1 plus G. Let's continue with this example. What is the price expected to be in year 4? Well, the price in year 4 is going to be your dividend in year 5 over R minus G. Very important, take note of that. The price in year 4 is going to be your next dividend, dividend in year 5 over R minus G. Your price in year 50 is going to be your next dividend, dividend in year 51 over R minus G. Your price in year 10 is going to be your dividend in year 11 over R minus G. Your price in year 6 is going to be your dividend in year 7 over R minus G. Okay? So this is what we have here. Our price in year 4, you find the dividend in year 5 over R minus G. Or you could always, as we've done here, calculate the dividends for each year to get the dividend in year 5. This is a shorter way you see here, where 4 times 1 plus 0.06 to the 4th power. If you go back to chapter 5, finding the future value, you understand completely what's going on here. So what is the implied return given the change in price during the 4-year period? Well, the price we found was $50.50, right? That was the price in year 5. The price today we found was $40. Look at the previous slide. We're looking at a 4-year period, and we're asked for the implied return. So if we're asked for the implied return, you know immediately you're solving for your IY, right? You want your required return. So you see here that the implied return is 6%, which isn't surprising because you know you've already been told in the previous slide that the growth rate is 6%. So take note of this point. The price is assumed to grow at the same rate as the dividends. Okay? Okay. So let's move on to the non-constant growth problem. And this is one that normally gives students some problems, so you might want to do as many examples as possible. Suppose a firm is expected to increase dividends by 20% in 1 year and by 15% in 2 years. After that, dividends will increase at a rate of 5% per year. So in year 1, you have a growth rate of 20%. In year 2, you have a growth rate of 15%. And after that, we have a constant growth rate of 5%, right? A constant growth rate of 5%. If the last dividend was $1, which means that your D sub 0 is $1, and the required return is 20%, what is the price of the stock? And remember, very important once again, we have to find the present value of all future dividends. So here we look at the solution. Remember, we were given our D0 of $1. That's our dividend that was already paid. We're told that the growth rate in year 1 is 20%, so our dividend for year 1 is $1.20 because the growth rate is 20%. Our dividend in year 2 is $1.20 times 1.15 because our growth rate in year 2 is 15%. After year 2, the growth rate becomes a constant 5%. So our dividend in year 3 is 1.38 times 1.05. Step 1 is always find the price of the stock at the point at which it becomes constant. So in this example, you see that after year 2, we have constant growth of 5%. So you find the price of the stock in year 2. And the price of the stock in year 2 is equal to your dividend in year 3 over R minus G. And we see that the price of the stock in year 2, is 9.66 cents. So once again, you want to find the price of the stock at that point where it becomes constant. So after year 2, we have a constant growth of 5%. So you find the price of the stock in year 2. It's going to be equal to your dividend in year 3 over R minus G. Then, what are our cash flows? Well, we know we have a cash flow of $9.66 in year 2. That's what the stock could be sold for. We have a dividend of $1.38 also in year 2. We discount that to the present. And we have our dividend in year 1 of $1.20. Okay, so the price of the stock is that future dividend in year 1, $1.20, plus your dividend in year 2, plus what it's going to be worth, what the stock is going to be worth in year 2. And you discount those using not your growth rate, using your required return. Okay? So step 1, find the price of the stock at the point where the growth rate becomes constant. Step 2, find the present value of the expected future cash flows. The present value of the expected future cash flows. Take note that the dividend of $1, which was already paid, is not included in the discounting. So let's look at our first quiz. What is the value of a stock that is expected to pay a constant dividend of $2 per year if the required return is 15%? We recognize immediately that this is a perpetuity because it pays a constant dividend of $2 per year. There is no growth rate. This is a perpetuity, so the price of the stock is going to be 2 divided by 0.15. Are you with me? 2 divided by 0.15. And what is that equal to? Well, 2 divided by 0.15 is equal to $13.33. The second part of the quiz says, what if the company starts increasing dividends by 3% per year? Well, it means that your growth rate is 3%. Beginning with the next dividend, and you're told that the required return stays at 15%. Well, you see here that your next dividend is $2 divided by 0.15 minus 0.03. So once again, $2 divided by 0.15 minus 0.03 is equal to $16.67. Okay, so as you work these problems, the first part you should get $13.33. The second part you should get $16.67. Okay, so let's look at how we find the required return from these formulas. Well, if you use the dividend growth model, that's what DGM stands for, the dividend growth model, we know that the price of the stock is equal to your D1 over R minus G. Therefore, if you take R out of this equation, you'll be left with D1 over the price plus G. Now I want you to take note of this formula, very important, because sometimes you'll be asked to find the required return. Well, the required return is D1 over the price plus G. Take note that D1 over the price is your dividend yield. Okay, your dividend yield. D1 divided by the price is your dividend yield. So if you're ever asked for the dividend yield, then you would need to take your expected dividend and divide it by the price to get your dividend yield, whereas your G is your capital gains yield. Okay? So take note of this formula. Let's do an example. Suppose a firm's stock is selling for $10.50. It just paid $1 dividend, and dividends are expected to grow at 5% per year. What is the required return? Well, the thing you need to take note of in this example is that the dollar dividend was already paid. It has already been paid. So you want to find your next dividend, which is why it's multiplied by 1.05 before dividing by the price of $10.50, and then you add on the 5% growth rate. So you see that the required return is 15%. So once again, before you attempt any of these questions, you need to ask yourself, am I given D0 or am I given D sub 1? If the dividend has already been paid, you have D sub 0. If the dividend is expected to be paid, you have your next dividend, or D1. What is the dividend yield? Well, remember I said the dividend yield is your next dividend over the price. So it's simply 1.05 over the price of 1050 of 10%, which is equal to 10%. So if you know your required return is 15% and you know your dividend yield is 10%, then your capital gains yield must be 5%. Okay? Your total return or your required return is equal to your dividend yield plus your capital gains yield. So here's a summary of what we've done before. Here are all the formulas. You'll want to take note of these as you attempt some of the problems. Okay? And remember, your homework is already available on Connect, so you could practice, get immediate feedback, get a sense as to whether or not you understand Stock Valuation Chapter 8. And I encourage you, please, to email me if you have any questions. If you'd like to know where you went wrong, please email me. Okay, so let's briefly look at features of common stock. We have voting rights. We rarely have two types of voting when we talk about voting rights. We have cumulative voting, where a shareholder casts all his or her votes for one board member. That's cumulative voting. A shareholder casts all his or her votes for one board member. Then we have straight voting, where a shareholder casts all votes for each board member. So there's cumulative voting and there's straight voting. In cumulative voting, a shareholder casts all votes for one board member. In straight voting, a shareholder casts all votes for each board member. And the directors are elected one at a time. In proxy voting, you give your right to vote to another shareholder. And this is done all the time. Sometimes you can't attend a meeting, you give your right to vote to another shareholder. And then we have classes of common stock. If you look at the financial statements for certain companies, I know Ford, you'll see Class A stock, Class B stock. Different classes of common stock are just created with unequal voting rights. So Class A might have voting rights, whereas Class B doesn't, or Class B might have voting rights, whereas Class A doesn't. So whenever you see different classes of stock, it's rarely created with unequal voting rights. And there are other rights where shareholders share proportionally in declared dividends, or they share proportionally in remaining assets if there's a liquidation. And there's also something called preemptive right, where current shareholders have the first shot at buying any new stock that is issued. Okay, so to maintain their ownership, then they get the first shot to purchase any new stock. Okay, and that's what preemptive right means, that current shareholders get the first opportunity to purchase any new stock that is issued. Okay, what are some of the dividend characteristics? Some of these we've touched on before. Dividends clearly are not a liability of the firm, which means that dividends don't have to be paid. So until a dividend has been declared by a board, it is not a liability of the firm and it doesn't have to be paid. After that dividend has been declared by the board, then the dividend has to be paid. Okay? A firm, therefore, unlike debt, unlike with bonds, a firm cannot go bankrupt for not declaring dividends or not paying dividends. Okay? So here's another difference between debt and equity. A firm cannot go bankrupt for not declaring dividends, whereas with debt, a firm can go bankrupt for not making their interest payments. Okay? What is the relationship between dividends and taxes? Well, unlike debt or interest on debt, Dividend payments are not considered a business expense, therefore they are not tax deductible. Whereas we know that interest on debt is tax deductible, dividend payments are not. They are not considered a business expense, therefore they are not tax deductible. Okay? So here's another difference. Interest on debt is tax deductible. Dividend payments are not. Taxation of dividends received by individuals depends on the holding period. How long have you held it for? Whereas when we talk about dividends received by corporations, we need to know that 70% of the dividends received by corporations are excluded from taxes. Okay? 70% are excluded from taxes. This is important for many companies because it helps them decrease their tax liability. So instead of, for example, investing in a company that doesn't pay dividends, they may choose to invest in a company that pays dividends because they know that 70% of that would be excluded from taxes. Okay? What are some of the features of preferred stock? Well, once again, dividends. When it comes to preferred stockholders get paid before your common stockholders. Okay? So any dividends that are paid, preferred stockholders get paid first. So we see that the stated dividend that must be paid before dividends, right? The stated dividend that must be paid before dividends can be paid to common stockholders. So preferred stockholders must be paid before your common stockholders. Okay? Once again, we know that dividends are not a liability of the firm and they could be deferred indefinitely. Okay? Another point is that most preferred dividends are cumulative, which means that any missed preferred dividends must be paid before common dividends can be paid. In other words, common stockholders cannot receive any dividends before preferred stockholders are paid. And lastly, of course, preferred stock generally does not have any voting rights. Okay? Preferred stock generally does not have voting rights. Okay? Let's just talk briefly about the stock market. We first look at dealers versus brokers. Of course, we talk about the primary and the secondary markets. Any new issue of securities is done in the primary markets, and any subsequent trading of securities is done in the secondary markets. So once again, new issues of securities done in the primary markets, subsequent trading done in the secondary markets. And we talk about dealers versus brokers. No, most students don't understand the difference between the two, and it's really simple. A dealer has inventory of securities, so he or she buys and sells securities constantly at any one time. A dealer actually has an inventory of securities. A broker, on the other hand, does not have inventory, but brings buyers and sellers together. Okay? So a broker does not have inventory, but brings buyers and sellers together. How does a dealer make his money? Well, a dealer will buy at the bid price, the lower price, we call that the bid price, and sell at the ask price, the higher price. So the difference between the bid price and the ask price is the profit. And that is often called the bid-ask spread. Okay, the bid price, the ask price, the difference between the two is the profit, called the bid-ask spread. Okay, so of course we look at the New York Stock Exchange. We know it's one of the largest in the world. You have about, less than $1,400 license holders. A member of the stock exchange has a trading license. right? So you must be a license holder in order to trade on the New York Stock Exchange. You have commission brokers who can buy and sell stock on the trading floor. So commission brokers buy and sell stock on the trading floor. You have the specialists who are members, dealers with a small number of securities. You have floor brokers who execute the orders for commission brokers. So the floor brokers execute the orders for commission brokers. And you have the floor traders who trade for their own account. Okay? So the floor traders trade for their own account. All right? And like I said before, I think I've mentioned in class that, before 9/11, you could actually go to the New York Stock Exchange and see the traders doing their work, but this was all shut off from the public after 9/11. Okay? So now we look at NASDAQ, which is an over-the-counter market, right? Mostly dealers who buy and sell for their own accounts, right? As we've said before, it's not a physical exchange, okay? So when you look at TV and you see that nice building in New York, I believe the lighting is in blue, it's just offices in there. It's not a physical exchange, okay? So you have multiple market makers, many dealers who buy and sell for their own accounts. All the trading is done via a telecommunications network, an electronic communications network. You have 3 levels of information that, that normally is paid for, right? And we also know that you have a large portion of tech stocks traded on the NASDAQ. Now, there's no hard and fast rule saying that technology stocks cannot be traded on the New York Stock Exchange. It's just that most tech stocks are traded on the NASDAQ. Okay? Okay, so we'll skip this work the web example. You could take a look at that. To visit Instanet, you could do that on your own. We look at reading stock quotes, and that's something you're familiar with. If you go to Google or Yahoo Finance, you'll see, the price of the stock. You'll see the last trade, the time of the last trade, the change in price, right? From the previous close, you'll see the bid price, you'll see the ask price, and you'll see other information. Right? You'll see, if you look on the right side of this, you'll see the dividend yield, you'll see the price earnings ratio, you'll see the earnings per share, etc. These are all things that we've spoken about in class, so you could take a look at that. Okay? So let's move on to our quick quiz. Right? You see here that all of this, like I said, you could go to Yahoo, Google, even Bloomberg, as is noted here, to get, just to take a look more closely at these quotes. Okay, so let's go on to our quick quiz. You observe a stock price of $18.75. So the price of the stock is $18.75. You expect a dividend growth rate of 5%. And the most recent dividend was $1.50. What is the required return? Right? What is the required return? The first question you ask yourself is, that dividend that I was given, has it already been paid, or is it an expected dividend? And we see here the most recent dividend. So this dividend has already been paid. So $1.50 is your D0. Remember, the formula to find the required return is equal to your D1 over the price plus G, where D1 over the price is your capital gain, is your dividend yield, and G is your capital gains yield. So how do you find the required return? Well, since you're given the most recent dividend of $1.50, you'll have to multiply it by the growth rate, right? So $1.50 times 1.05 divided by $18.75, the price of your stock, plus your growth rate of 0.05, and you should get an answer 13.4%. Okay, once again, 13.4%. And I must say this again, the most common error on the exam is not recognizing when you've been given the next dividend, your D1, or when you're given a dividend that has already been paid, your D0. In this case, in this example, this is 150 has already been paid. It's your D0. You want your D1, so you have to multiply 150 times 1.05. Divide that by 18.75, and whatever you get, you add on 0.05, your growth rate, to get an answer of 13.4%. What are some of the major characteristics of common stock? I leave that to you to read about. We've gone through that. What are some of the major characteristics of preferred stock? I also leave that to you to go over. Okay? Okay. So let's go past this. Ethics issues, as usual, don't lie, cheat, or steal. And here we have the comprehensive problem. Okay? XYZ stock currently sells for $50 per share. The next expected annual dividend is $2, and the growth rate is 6%. What is the expected rate of return on this stock? And I'll let you calculate this on your own. I'll tell you that the answer is 10%. So part A is 10%. So I want you to practice and calculate this on your own. All right? Part B says if the required rate of return on the stock were 12%, what would the stock price be? Right? You know the next dividend. You know the growth rate is 6%, and you're now told that the required return is 12%. What is the price of the stock? You should be able to find that. And I'll tell you the answer is $33.33, but you need to calculate it. And then you're asked, what would the dividend yield be? Well, you know the dividend yield is your next dividend, your $2 over the price which you just calculated, $33.33. And you'll see that your dividend yield is 6%. Okay? So we've come to the end of chapter 8, stock valuation. What I'll do in the next video is I'll go through some problems at the end of the chapter, and then I will post a problem set so that you could practice on your own to get a sense of whether you understand this material or not. Also remember, the homework for chapter 8 is on Connect. If you do the homework, you'll get a sense of whether you understand the material, and you will get immediate feedback on the questions that you have answered. Take care and study hard.